Welcome to Talk Tickers. Today we're diving deep into the latest earnings call from CleanSpark. They're a pretty significant player in Bitcoin mining.
Yeah, a big one. And our goal here, as always, is to pull out the key insights for you, the experienced investor listening in.
Definitely. So this quarter's call, it really paints a picture of, well, substantial growth, but also some interesting strategic moves in a market that's always changing.
It really does. Should we jump straight into the headline numbers, get a snapshot first?
Yeah, absolutely. Let's do that.
Yeah.
So revenue for Q2, pretty impressive jumps. It hit $181.7 million.
Wow, okay. And how does that stack up?
Well, that's a hefty 62.5% increase compared to the same time last year.
62%, yeah, that's strong.
And also a solid 12% rise from just the previous quarter. So good sequential growth too.
And it wasn't just the top line, right? Gross profit.
No, that also saw really significant gains. It reached nearly $100 million.
Okay, almost 100 million. That's up over 24% year over year.
And almost 5% up sequentially. It gives them a pretty robust gross margin. What was it, 53%?
53% margin. Okay. Now, those numbers sound great, but didn't they report a net loss?
They did, yes. There was a net loss for the quarter.
Mm-hmm.
But the main reason for that was a mark-to-market adjustment.
Ah, okay. So basically, Bitcoin's price dipped near the end of March.
Exactly. And they had to adjust the value of their Bitcoin holdings on their books because of accounting rules. That hit the bottom line.
Right. But it's crucial to remember that's a non-cash charge. It's accounting, not, money out the door.
Precisely. And they made a point of saying the price of Bitcoin has bounced back significantly since then in April. Even crossed $100,000 apparently.
Okay, good context. What about actual Bitcoin production? How did that look?
Still strong. They mined 1,957 Bitcoin in Q2.
1,957. Is that up or down?
It's actually a slight decrease, but 3.6% year over year. But, and this is important.
Halving.
Exactly. We have to remember the Bitcoin halving happened in late April. That event cuts mining rewards in half.
Right. So maintain production close to previous levels after the reward got cut is, well, it's actually pretty notable. Shows efficiency gains, maybe.
Could be. And what's also striking is the average revenue they got per Bitcoin. That surged.
Oh, yeah. How much?
Nearly 69% year over year, up to $92,811 per coin on average.
Wow, 69%. And quarter over quarter.
Also up. A healthy 10.5% increase from Q1. So higher Bitcoin prices definitely helped the revenue side.
Sure, makes sense. But what about the cost side? Mining isn't free. Did the cost per coin change?
It did go up. The marginal cost to mine each Bitcoin rose to approximately $42,600.
42. Okay, that's about a 26% increase from the first quarter.
Yeah, around that. They said it was a mix of factors. The network difficulty keeps going up, making it harder to mine.
Always does.
And also just generally higher power prices across the country impacting them.
Right. Energy is the big input cost. Okay. How about their Bitcoin stash? Are they still holding on to it?
They are. Their treasury, it keeps growing. As of April 30th, they held over 12,100 Bitcoin.
12,100. And based on April's prices, that's worth
over $1.2 billion.
A significant asset on the balance sheet.
Definitely. And overall liquidity looks strong too.
Yeah.
They reported over $1 billion in total liquidity at the end of Q2. That includes about $97 million in actual cash, plus all that Bitcoin.
Okay, so solid financial footing. Now, beyond the numbers, the call seemed to really hammer home their strategic focus, didn't it, on fundamentals?
It really did. They talked a lot about focusing on things like cash-on-cash returns and managing their margin carefully, not just chasing one single metric like hash rate.
Right. And what I found interesting was their comment about power prices. They seemed willing to accept slightly higher costs sometimes.
Yeah. If it drives better bottom line value overall, it's a more nuanced approach than just saying lowest power cost wins. Maybe it's about uptime or reliability in those locations.
Could be. And that ties into their operational setup, right? Spreading things out.
Exactly. Their infrastructure is across 4 different states now: Georgia, Tennessee, Wyoming, and Mississippi.
That geographical diversification, it must help buffer against, regional spikes in energy costs. One area might be high, another lower.
For sure. And they mentioned getting a better blockchain-specific energy tariff sorted out in Wyoming, which helps there too.
Right. So the takeaway seems to be maximizing production and profit, even if the cost per kilowatt hour isn't always the absolute rock bottom everywhere.
Yeah, and that strategy seems to be working for them, given that 53% plus gross margin they achieved.
Makes sense. Now, what about how they're managing their capital? Any shifts there?
Yes, a notable evolution. They mentioned moving away from the almost 100% HODL strategy, holding all mined Bitcoin that they adopted late last year.
Okay, so they're selling some now.
Yeah, strategically monetizing a portion of their monthly Bitcoin production. Primarily, they said, to support ongoing operations.
That's a pragmatic shift. And importantly for investors, especially in this sector, what about equity dilution?
Big point they emphasized. No equity dilution since they finished their ATM program last November. And crucially, they stated they have no current plans to initiate any new equity offerings.
That's music to shareholders' ears, usually. So they're looking at other ways to fund things.
Seems like it. They talked about diversifying their capital structure, leveraging their strong balance sheet for accretive opportunities.
Like that expanded credit line with Coinbase.
Exactly. They upped that to $200 million using their Bitcoin as collateral. Gives them a lot of financial flexibility without selling shares.
Okay. So they've got the finances. What about growth? What are the expansion plans looking like?
Ambitious. They're on track, they say, to reach 50 exahash of computing power by mid-2025.
50 exahash. That's a huge number in the mining world.
It is. And they also mention having infrastructure already under contract to support growth even beyond that, up to potentially 60 exahash.
How are they planning to get there? Just building new sites?
It's a mix. Organic growth at existing sites, ground-up development of new locations, and they're also looking at opportunistic acquisitions.
Buying up smaller players, maybe?
Potentially. But the focus, they stressed, is on ROI-positive growth, funded mainly through non-dilutive sources, cash flow, that credit line, maybe strategic Bitcoin sales.
Got it. Any specific projects they mentioned?
Yeah, they highlighted significant capacity additions in Wyoming during Q2, over 3 exahash added there, plus active ground-up projects ongoing in Wyoming and Tennessee, and expansions happening in Georgia and Mississippi too.
So activity across their footprint. But I thought I heard something about a change in their guidance.
They did. It was subtle, but they seem to be modifying their growth guidance slightly, moving away from very strict time-bound hash rate targets.
Interesting. More emphasis on being disciplined and opportunistic, maybe.
That's the feel I got. Like, focus on smart, sustainable growth, not just hitting a number by a specific date, whatever the cost.
That sounds like a mature approach. What about competitive advantages? What makes them think they can keep winning?
They listed quite a few. Fleet efficiency is one, getting more computations per unit of energy. They're under 17 joules per terahash now.
Which is really important with rising energy costs and network difficulty. Efficiency becomes key.
Absolutely. They also highlighted their power contracts approaching 1 gigawatt under contract now. That's massive scale.
And their Bitcoin treasury itself is an advantage, right? Third largest among public miners.
Correct. And they made a point that it's all mined in the U.S. Plus, their proactive procurement of mining machines means they've kind of insulated themselves from near-term tariff risks.
How so?
They said the machines they need to reach that 50 exahash target are already physically in the U.S., so potential new tariffs wouldn't hit that specific goal.
Smart planning. And they even see tariffs as maybe creating M&A opportunities for them.
Yeah, if tariffs persist, it might pressure smaller miners, potentially making them acquisition targets at attractive valuations for a company like CleanSpark with a strong balance sheet.
Makes sense. They're getting external recognition too, right?
They are. Ranked number 35 in that Financial Times list of the 500 fastest growing companies in the Americas for 2025.
That's quite an achievement.
And they were also added to the S&P Small Cap 600 Index, which they noted has helped boost their institutional ownership to nearly 64%.
So more established investors are taking notice. They really position themselves as this vertically integrated, operationally disciplined company with a long-term view.
Exactly. And that ties into this concept they introduced called escape velocity.
Escape velocity. What does that mean in this context?
Basically, reaching a critical point where their scale, their operational performance, and their financial discipline are generating enough positive cash flow sustainably to well exceed their costs.
So moving from needing external capital to fuel growth to being largely self-funding.
Precisely. They believe they're hitting that transition point. They think they're widening their lead in efficiency, capital management, adaptability.
Creating a durable competitive advantage, especially as they see themselves as the sort of last pure play, vertically integrated miner standing.
That's the narrative. They also touched on how being a flexible energy load actually helps power grids adding another strategic layer.
Interesting angle. Now, another area that caught my ear was digital asset management. What's happening there?
Yeah, they're actively building that out. An institutional grade function, they called it.
Meaning more sophisticated ways to handle their Bitcoin.
Looks like it. They're in the final stages of negotiating ISDA agreements. Those are standard contracts for over-the-counter derivatives.
Okay, so that opens the door to things like hedging, yield generation.
Exactly. They specifically mentioned exploring strategies like covered calls to generate yield on their Bitcoin holdings.
Covered calls on Bitcoin, that's becoming more common. What kind of yield are they targeting?
They mentioned a target of mid-single-digit annualized yield on their entire Bitcoin balance, but stressed it would be a conservative approach.
Mid-single digits on over $1 billion in Bitcoin. That's not insignificant potential income.
Not at all. They also highlighted a kind of unique deal. They did use Bitcoin to acquire some miners, got a 15% discount, and a call option for more. Pretty creative financing.
Very interesting. Okay, what about their view on the broader market? What are they seeing?
They seem to believe that there isn't a flood of new investment coming into the network hash rate right now.
Which would be good for existing players like them, right? Less competition means potentially higher share of the rewards.
That's the idea. They also expect mining rig prices might continue to face downward pressure, maybe because some competitors are slowing down their buying.
Creating more buying opportunities for CleanSpark, perhaps?
Possibly, especially for those bolt-on acquisitions they mentioned. They seem confident about finding power in their operating regions, maybe contrasting with hyperscalers who might be shifting where they build data centers.
Right, and they're leaning into immersion cooling for future builds.
Yeah, seems to be the focus for ground-up projects.
Yeah.
Provides more flexibility, they said.
Okay, so pulling this all together for the investor listening, what are the key things to keep in mind about CleanSpark right now?
Well, I think one major point is their unwavering focus on Bitcoin mining. Unlike some peers who are pivoting or diversifying into, say, HPC or AI.
Right, CleanSpark is staying laser focused on Bitcoin.
Yeah. And their disciplined capital allocation, especially avoiding equity dilution, is really noteworthy in this market. That's a big differentiator.
Absolutely. That strategic shift, selling some Bitcoin for operations while still growing the overall treasury, that's also a unique approach compared to pure HODL or selling everything.
Right, it's a balance. And this developing digital asset management strategy, that could add another layer of returns down the road if they execute well.
Definitely one to watch. And finally, that escape velocity concept. If they've truly reached a point of sustainable, internally funded growth, that's a very compelling story for long-term believers in the space.
It really is. Okay, shall we move on to our this is not financial advice segment? Throw out some wild ideas.
Let's do it. Always fun. But seriously, folks, not financial advice. Just brainstorming based on the call.
Exactly. Okay, outrageous but plausible idea number one. Given CleanSpark's strong balance sheet, their commitment to non-dilutive growth, and the potential consolidation, maybe consider a pairs trade.
Okay, how'd that work?
You could potentially go long CleanSpark, betting on their execution and financial strength.
Yeah.
And simultaneously, maybe identify a miner who looks more vulnerable.
Like someone heavily reliant on future equity raises, or maybe struggling with costs.
Right. And consider a short position in that weaker player. The idea is CleanSpark outperforms, maybe even acquires assets from struggling competitors. It bets on that divergence.
Interesting. A bet on fundamentals winning out. But again, highly speculative, requires deep research on both sides.
Absolutely. Do your own homework. Okay. Idea number two, playing off their digital asset management move.
The covered calls.
Yeah. CleanSpark mentioned seeing juicy premiums there. So maybe an investor who already holds Bitcoin could consider mirroring that strategy on a personal level.
How so? Like writing out of the money covered calls on a portion of their own Bitcoin to generate some yield.
Exactly. While perhaps also holding CleanSpark stock, sort of aligning with the company's own treasury strategy. You generate income from your Bitcoin while betting on CleanSpark's operational success.
A way to potentially enhance returns on existing holdings, inspired by the company's own tactics. But options trading is complex and risky.
Very risky. Definitely not for everyone. And again, just an idea for discussion, not a recommendation. Please remember that.
Always. Okay, so that feels like a pretty thorough breakdown of the CleanSpark call.
Yeah, I think we covered the key points. So wrapping up our deep dive, the big takeaways really are that strong growth in revenue and gross profit, the smart evolution in their capital strategy moving away from dilution.
Their confident outlook on expansion, but maybe in a more disciplined way now, and that emerging digital asset management piece is definitely something to track.
For sure. We highlighted their unique approach to navigating things like power costs and potential tariffs. And of course, those couple of outrageous but plausible trade ideas for you to ponder.
Remember, not financial advice.
Never is. We'd love to hear what stood out to you in the report. What are your thoughts on CleanSpark's path forward? Let us know on your usual platform.
Yeah, join the conversation.
Thanks for tuning in to Talk Tickers. We'll be back soon to dissect another important earnings call. Until next time.